What happened to the Canva link?
Hello and a very good evening to each one of you. I'm Vinay Dora from the NASSCOM ProductSkills team and an entrepreneur with Crowd Product. Today, I would like to cordially welcome to what would be another thought-provoking webinar, this one on financial acumen for product managers by Prajwal Ajay. Prajwal, also known as the accidental PM, a science student at school turned chartered accountant by qualification. Prajwal has worked for 3 years at PricewaterhouseCoopers before founding his IoT startup, Gordian Technologies. For aspiring product managers, this session will be highly valuable, as well as for expert PMs too, who will get a ringside view of the kind of young product managers they may be hiring and interacting with in the present and near future. So please do share your thoughts, questions, and experiences in the chat window. Stay till the end, for at 5 p.m. we'll be summarizing the session takeaways. We also joined here by NPS student volunteers, Pooja from Catalyst and Daisy from IIM Calcutta, who will also be interacting with the speaker. And with this, I would like to once again cordially welcome Prajwal. Over to you, Prajwal.
Hey, thank you so much, Vinay. I'm so glad all of you could take time out on a Saturday evening to join this call. Hopefully, this is going to be some value add to you in terms of your product journey, product or manager journey. There are basic concepts that you're supposed to be knowing, especially on your journey as a product manager when you're taking decisions on what products to bring in, whether it makes sense to bring in the product, etc. So I love to take sessions where the entire session is in ELFI format. ELFI is a concept I picked up from Reddit. It's called Explain Like I'm 5 or The Office, whatever reference you get. So basically, all concepts are, I try and break down like complicated concepts in a way where even a 5-year-old can understand. So hopefully, it makes, you guys can take away something from the session. And let me just share my screen and take you guys through the presentation and everything else. Just give me a second. Yep. Can you guys see my screen? Okay, sure. I hope you guys can see the screen now. Yep. So I'm just going to move this. Financial literacy for product is basically, okay, what is a product manager? Whenever you, product managers are basically a wide set of people, right? So whenever you look at product managers, you need to look at UX, you need to look at tech, you need to look at finance, you need to look at it from all the perspectives, right? So it's never one single thing that you need to look at. So I'm just trying to explain the concepts related to finance so that your understanding can be a little better. So let's try and understand what are the basic concepts that are required for you to understand when you're making a decision, and how do you make decisions once you understand the basic concepts. Then we can cover a little bit of pricing models and approach to innovative thinking, and then I can give you some real life case studies of Paytm, WeWork, and then your Ford, your Airbnb, and then what worked for Ford versus what didn't work for Ford versus what worked for Porsche, and different other cases. So I'm just going to start with a very basic example of, yeah. Can you guys see the Excel file?
Yes.
Yeah. Okay. Let's assume that. Okay, let's take a very simple scenario where you have a student who is putting up a stall in the annual fest for a school, right? Let's assume it's a kid who is basically going to be selling pens. So so her thought process is she's just going to be buying pens from a school and from a neighborhood store, and then selling it in a school by putting up a stall. So now how like the entire thing can be understood like, let's bring in 3 cost concepts here. Cost, what is a variable cost, what is a fixed cost, and what is basically what is your fixed asset, what is your expense, and all these things we'll cover. In this basic example, let's cover your variable cost, right? So now basically if she's buying one pen, in case she doesn't need to buy this pen if she's not selling any product, right? So variable costs are incurred only if there is actually a sale made. If a sale is not made, you don't have to incur variable cost. However, fixed cost is something that you'll have to incur irrespective. There is a stall that she'll have to pay for putting up the stall. Let's stall $120. Now, if the teacher's charging 120 rupees for the student, irrespective of whether you make any sale or not, you're incurring that cost irrespective of whether you sell any pen. That's when it becomes your fixed cost. Now, if you have your fixed cost as 120 rupees, let's break it down. Let's assume that you're selling the pen at 10 rupees per pen. Your variable cost, let's assume that you have two types of variable cost. If you sell a pen, will you need to pay for it? Only if you sell a pen, will you need a gift box for it. So both of them become variable. Otherwise, you can return whatever it is that you once sold based on your deal with the shopkeeper or anything else. So your variable cost for selling is basically 3, and your gift box is 1. So your total cost of 4. So if your sales is for 10 rupees, and if your variable cost of 4 rupees, how much would profit be? Pooja, do you want to Pooja, are you there? Okay. Anyway, so basically, I was saying, if you're selling something for 10 and then your variable cost of 4, your per unit cost is going to be 6 rupees. So now what you need to understand is the 6 rupees is a profit that is there with you to recover the cost of 120 rupees that you've already paid for the stall. So now how do you calculate that? How many pens do you have to sell for you to be at least at a no profit, no loss scenario? No profit, no loss scenario in the costing circles is called as break even, right? So if you look at 120 as your fixed cost, you'll have to at least sell 20 pens for you to be able to recover the 120 rupees. How did we calculate this? Simple. You have 120 divided by 6 gives you 20. If you look at this is basically 120 divided by 6 gives you 20. So you need to sell at least 20 pens for you to be able to be in a situation where you're not making any loss and not making any profit. The question arises as to why should I know whether something is a fixed cost or a variable cost or anything else? So let's jump into like basic scenario. Let's tweak small things in this and try and understand, like, what, like, would your decision making change if, like, your variable cost increases or anything? Let's assume that your teacher has already collected the rent from you. You have already paid the rent, and the shopkeeper now tells you, hey, listen, this is the price have shot up. I'm going to charge you 7 rupees for a pen instead of 3 rupees. So now that you have a profit of 2 rupees per pen and you put up the stall, if you do the math, you will have to sell at least 60 pens for you to be able to make profit, like, or not make profit, like not incur loss, essentially, your 60 pens. Now, your decision as to whether to put up the stall or not at this point of time shouldn't be determined based on how much profit you can make per pen, unless it's negative. Say this pen itself costs you $11, right? If this pen costs you $11, then you're making a loss by just buying the pens from the shopkeeper and trying to sell it at 10 rupees. You can either increase the selling price more than 10, or if you're keeping the selling price at 10, then you might as well not put the stall, even though you've already incurred that 120 rupees. You don't use that for your decision making. So now let's assume that this guy is charging us 7. So you have 10 rupees that you're selling a pen at. 8 rupees is variable cost, 2 rupees is your profit. Now that you've already paid the rent to the teacher, you might as well, like, go and try and sell as many pens as possible. Look here. So I put it in, like, a schedule of small number of pens. Even if you sell 15 rupees, you're going to make a profit of 30 rupees. How do you decide? 2 rupees is per pen profit that you're making. 2 rupees into 15 is basically 30 rupees. So now at least 30 rupees profit you're making by putting up this thing. So your total loss would reduce by 30 rupees. So 120 is the amount that you're paid already for the stall. 120 minus 30 is 90. So you're incurring a loss of at least only 90 then. So you can try how many you can try putting up a stall and selling how many pens you can, so that you minimize your losses. Now let's take another scenario, tweak it a little bit. We'll say the rent is unpaid. The teacher is like, okay, you can pay the rent later, or you can decide not to put the stall. And the shopkeeper increases to 7. And there are 80 students in class, and you've spoken to all of them, and they all want the pens. So it makes sense to put up the stall now, right? Because you're breaking even by selling 60 pens. If you sell 60 pens, you're going to make a profit. You're going to make no profit, no loss. But if you're selling 80 pens, then you're making a profit of 20 pens. That is more than the 60. So basically 80 students are buying, so you have to sell 60 pens to recover your 120 rupees cost, and 80 minus 60 is basically your 20. So let me know if I'm losing you guys anywhere. I can slow down a little bit or go a little faster. But yeah, so essentially this is what happens in terms of decision making. Now you just need to understand what is your minimum number of units that you need to sell, and then make your decision. So it becomes easy. If you look at the third scenario, rent is unpaid, shopkeeper increases the price of the pen to 7, and only 30 students are there in class, and everyone says they'll buy only one pen. So because you'll have to sell minimum 60 pens for you to break even at this price point, you might as well not put up the stall, because you'll be incurring a loss by putting up the stall. So now,
so basically
yeah.
here
Yeah.
so just had this question. So
Uh-huh.
basically here in general we are trying to figure out whether it is profitable for us to even create the product or not, like in this case
Exactly.
sell the product or not. So that is how this whole scenario fits into the product management domain, like whether going ahead with this particular feature etc is profitable or not, right?
Right.
Okay.
Exactly. So basically, we're trying to cover a few concepts here, and all these concepts will be extremely relevant, especially when you're trying to decide on building a new product, developing, adding new features to your existing product, to understand how much revenue can you generate out of it. If you can generate more revenue out of it, keeping your costs etc. constant, that's when it makes sense. Yeah.
Right.
So now I'd just like to introduce one small concept of your fixed asset or an expense. So technically speaking, expense is anything that is incurred, which gives you value once, and then or whatever it is, and the value generation is less than a year. So it can be paying rent for the stall, right? So if you're renting out the stall, and then you're not actually owning the asset, this becomes extremely crucial for your rent versus buy decision. So a lot of times, okay, I run a startup called Guardian. So what we do is we provide secure deliveries using these physical devices that our delivery executives carry. It's like, imagine portable lockers. The delivery executives carry this, and then when customers get an order, they need to basically, and they get an OTP on their phone, which they need to enter on the device, the locker. These are IoT enabled, so they're real time. So they unlock it and they place their parcel inside, lock it, and same thing happens at the delivery location as well. So in these kind of places, it becomes extremely crucial for you to understand on two fronts, whether to rent the entire device, if we're manufacturing this, whether to build a manufacturing plant ourselves, or to use models where you tie up with the factory where they just charge you for the electronics manufacturing and then the physical box manufacturing or anything else. For another example that's relevant in our startup is basically we had to build out the entire software for managing delivery executives. We had to get orders from delivery executives, manage them, assign them, do mapping, routing, etc. Instead of doing that, instead of building it, it's called build versus buy decisions. Because if you're building it, you have certain costs that are involved for sure, because you'll be hiring 3 developers, 2 developers, or whatever the number of developers required. You'll be paying for server space, etc. You'll also have to take a decision whether it's easier to plug into someone's SaaS product. SaaS is software as a service. Plug into their product and then use their APIs to just create orders. And manage everything on their platform. So, and then pay them on a per order basis. So these kind of decisions are extremely crucial, and you keep having them on a daily basis in your startup. So understanding these basic concepts of variable costs and fixed costs becomes extremely instrumental in taking your decision. And I hope that gives some clarity as to the product fit.
Yeah, right, it does.
Yeah, sure. Thank you. And in terms of would your decision change if the teacher sold the table? The reason why I put up this scenario is basically because this table is on rent, like the decisions that I was telling you about whether you own the asset or whether you rent out the asset, etc. If the teacher is still selling you the table for 120 rupees because they see no use to it after the event for whatever reasons, would your decision change is something that you like to understand. So now here there are only 30 students, right? If there are only 30 students, you'll have to sell 60 units to even break even. So you're essentially making a loss of 30. That is basically 30 into 2. Like if break even becomes complicated, a simple way to look at it is you have 2 rupees here per unit, 30 into 2. You multiply this with 30. So basically you are making a profit of 60 overall, but you're incurring a cost of 120. So you're making a loss of 60 rupees. So essentially now what happens is you need to understand if at all you can recover by renting out this table further to the next students who come in, etc., at another 60 bucks. So that you will be able to make some you'll be able to recover some money from it. So that's when your rent versus buy decisions come in. And you can look at and your decision can change if it moves from fixed asset to an expense. How are we doing on time? Okay, sure. So basically that's when so any expenditure that gives you a value over a period of 1 year, normally you treat it as a fixed asset, and that's when you consider your decisions based on how much is the lifetime value. If the asset can be, look at this example, let's assume that the table can be rented out every 6 months by the student once she buys it for 120 rupees at 40 rupees every time. Will this change your decision in terms of like whether she can go ahead? So basically she's making a loss of 60 rupees, right, by assuming that 30 students are buying the pens. So you have 60 rupees calculation that we have done in terms of loss here. Now assuming that 40 rupees she can charge from her students later by renting it out by classmates or juniors, she can basically recover the loss in two more quarters, right? Or two more whenever every 6 months, every half year. Within a year she can recover the loss. So based on your appetite for your cash flows, etc., you can determine whether you need to do that. Assuming that the table will stop being useful after 2 years, will it matter to your decision? Again, it's basic math. Again, you look at 40 rupees you're able to make every 6 months, 40 into so there are like 4 times that you can put it in 6 months. So 240 rupees is what you'll be able to make, which is much more than the loss you'll be incurring now. So definitely depending upon like whether you can afford to not receive the money now and receive the money later. If you can take a hit of 60 rupees loss today and receive the money in the future, that way you will be able to take this decision and then you can invest in the asset. Cash flows is becomes one of the most crucial things, especially in decision making, right? So let's assume that that's why you can see so many innovative business models come up right now where everyone lends out most of the things on a rental and subscription model rather than an asset model. There are startups that I've met who basically rent out the laptop to you, and you don't have to incur an upfront cost. For you will be having 30 employees that you have hired in the interim before you raise your next round. And imagine spending 30 into 1 lakh per Mac, you'll be spending 30 lakhs on your students right now, versus 30 into say 5,000 rupees that they charge on a rent basis. Your outflow right now is 1.5 lakh rupees itself. So your decisions as a product manager, I mean, this is not as a product manager, but again, as someone as a product owner, depends completely upon rent versus buy. I'm trying to give the most basic examples that everyone can relate to. And we can extrapolate this into your product decisions whenever you're building any product, etc. Unit economics is basically whatever we just learned, like till now. So by selling one product, how much is the profit or loss that you're going to be making, so that is profit that you're making or loss you're making, so that you can take decisions based on it. Yeah. Just 1 second. So let's just move on to the next slide. If you guys have any doubts, feel free to put it up in the chat, or so that we can cover it right now, and then before we move ahead. I can see one question which says labor expense is missed in the fixed cost. Yes. So there are a bunch of costs, right? Whenever you're looking at making a decision, there is material cost. In material cost, there is raw material cost. There's other types of costs that you need to consider. Your labor cost can be fixed cost, like labor cost can be variable cost, and then there can be factory overhead cost, and there can be thousands of costs that'll be there. But we are trying to keep the example simple, and in this case, we are ignoring that there might be labor expense involved because it's for our own enterprise. But we are covering opportunity cost and relevant costs in this slide, which will give you a little more understanding of like whether you look at her own enterprise as a labor expense, or whether you look at it as an opportunity cost, because she is not incurring any actual outflow of money. Expense is basically an outflow of money. She's actually not incurring any outflow of money, but it's a very relevant cost that you need to consider. Instead of looking at it as a labor expense, because she's not hiring anyone to stay at the stall, we are going to be considering it as an opportunity cost, which we're going to be covering now. So is there, okay. Malini is asking us to summarize. Cool. We can summarize the end of it, or we can just do it now. So basically, there are like multiple costs. Every cost can be classified into variable cost, fixed cost, or semi-variable costs. I don't want to get into semi-variable cost right now because it can get a little tricky. So you have variable costs and fixed costs that are there. So now it becomes extremely crucial for you to understand what is a variable cost and what is a fixed cost. And why is this important? Basically, your decision making can deter. You don't have to incur variable costs if at all you don't want to, if you're not undertaking the enterprise. Let's say we're not building a new product, we are not going to be incurring that cost, but there are certain fixed costs that will have to be incurred irrespective of whether you go and build it. Assume that you have rented out a factory for building out a product, right? And then you decide, okay, fine, like, now it doesn't make sense because product is not available, material cost is shot up or whatever. Fixed costs are already incurred right now, right? So now that's where we come into the relevant cost concept. Like, if at all it's already incurred, whether you need to consider it, or if you're going to incur it, whether you need to consider it, becomes extremely crucial in your decision-making process. Does anyone else have any other question? Sure. Okay. So let's look at what are relevant costs, right? So your relevant costs are basically the costs that are relevant for your decision making, as simple as that. Now, how do you decide if something's relevant? One is first of all, this cost has to incur in the future, right? And there's a very tricky concept. Even when basically I was understanding this during my CA and stuff, there's so many times we assume that something is not a relevant cost, but then it turn out to be a relevant cost, and vice versa, because this goes against everything that you would have learned in the way you think and do business, right? Especially when you're building a new product, your decision making is already set based on your budget sheets. Your budget sheet is going to be like, okay, this is a labor incurred for this developer who is already working on another project, so put that cost here, this thing, everything else. So relevant costs are basically something that are that go against what you normally understand in terms of your budgets, cost sheets, etc. Because these you'll have to, I think, with examples you'll understand a little better. One of the two things. One is relevant costs always occur in the future, right? So there is if it is already incurred, you don't have to worry about it. It's an irrelevant cost for you to make a decision. And the second thing is, it differs among alternate courses of action. If the cost and revenue don't differ in both the methods, say I am taking an auto or a cab, to my office, assuming that, because autos charge 1.5 in Bangalore, both of them cost the same. It doesn't matter what I need to do or like which path I take. They're both gonna cost me the same thing. So my decision making doesn't change. So just a random example, but very relevant. Before we jump into relevant cost again, because it's a little theoretical, let's look at a couple of pricing models, business models, and stuff like that, and go back to relevant cost. Willingness to pay is a concept. So one of the main things that you need to do when you're like as a part of product development, which is kind of related to finances, basically pricing your product. It can make or break the company. So there are different pricing models that we can look at, etc. But then let's understand the basic concept that anytime you want to build a product, right, understanding your customer is most crucial. And there's a concept called willingness to pay. Willingness to pay is basically how much money and for what is your customer ready to pay, right? So look at the example of there was this car back in 1960s. So this is basically a case study you can read in the book Art of Monetization. So basically your Fiat cars were extremely famous for their compact Dodge, but then they went out of business or they went out of production or anything else, and they wanted to bring it back with all glamour. And they thought, they advertised before bringing the product. They said, we have kept the finance guys out of the equation. It's only going to be the engineering teams. We have given a free hand to the engineering team. They can build anything that they want, all the features. So they took features from the next segment of the cars, put it in this cars. They tried bringing in as much as possible in the compact car, because they assume that people who are buying compact car want all the features at this thing without caring about the price. So they built it over a period of 1 or 2 years or a little longer. By the end of it, when they actually released it, no one wanted the product. It can be a Nano example as well. Nano went again. Nano was from a positioning perspective. So positioning and willingness to pay perspective, they tried targeting people who were basically buying two-wheelers, or for people who are buying two-wheelers, a car of 1.5 lakh or 1 lakh was too unaffordable. On the other hand, you have people who can afford a 2-3 lakh car like Alto or your 800 or anything else, felt, because they called it a very cheap car, they felt very insulted by going in a Nano. So they could not cater to even this market or that market, and that's where it fell apart. So willingness to pay of a customer and what features would they pay for, and obviously positioning is the next concept, but that becomes extremely crucial. On the other hand, your Porsche, so Porsche was always known for fast cars, right? So it was like you have a very fancy car with, basically it's known for speed. It's known for people to just take out a ride and then feel good and young about it. But then Porsche was planning to come up with a SUV, right? So if you're building an SUV like Cayenne, it's huge. Porsche was not known to make huge cars. They were known to make sleek cars, which was really nice. So what they did was immediately they went to the customers. They went to them. They had a huge survey budget. They went to them and they're like, okay, you tell me who is my customer segment? How much would you pay? Would you pay for this feature? If they said they wouldn't want this feature and they wouldn't pay extra money, they wouldn't have it. If they say that I want this feature but I wouldn't pay extra money, they would not have this feature. So understanding willingness to pay very early on is extremely crucial in your product journey, product building journey, especially because you will be deciding what features to build, etc. Let's look at another example. Airbnb I think most of you will be aware. For those who are not aware of what Airbnb is, it's a place where you can rent out your homes, your room, or whatever it is to another person to come stay. In the US, it started off as a couch. Like I could rent the couch in my hall and then they would come bunk there, right? So this is a concept that they started off with. Assume that, now, even in India, now I don't think people allow others to come in. We have evolved our own understanding of Airbnb and we rent out extra flats, etc. But having said that, imagine a world where people were not okay with people coming and sleeping on their couch. These guys had to think of some customer who would be willing to pay for their product. And the customers, they realized this was during the Obama's election in 2008. So he had gone for a rally, and they shifted the location from one of the bigger places to a smaller city due to other reasons. And all the places were sold out, and that town couldn't handle 80,000 people who were going to come. So that's when these guys thought, let's build out one small site, doesn't matter how good it is. They built an MVP, they put the product out, and all that they did was they went to thousands of people with a house, and then they just said, you know what, list on our platform, rent out your couch, doesn't matter what it is, customers will be willing to pay. You get money, you get to meet someone new. And that's how they started their business. So it's extremely crucial as to understanding who is willing to pay. On the other hand, if you look at Dropbox is basically an image sharing or any media storing and sharing app, right? So now Dropbox, initially, if they went to the consumers and said, hey, listen, you have 2 laptops or 3 laptops, and then you can sync files all across all laptops, no one will be like, I don't have 2 laptops, I don't relate to this problem, especially when they built it in 2007. But then who did? Your your developers, your devs, and then your finance guys, whoever it is. But then your developers initially is the market that they went to, and Dropbox went to them, and they're like, okay, I think they posted on Dig is a platform for where all these techies hang out. They posted a small demo of their MVP. The product was not ready to be deployed, but they just posted it because this is a community which is very active. They like new products, etc. And their beta list went from 5,000 to 75,000 overnight. That's how important it is to figure out who is willing to pay for your product and for what. Even if the willingness to pay is not there, if you're not getting money out of them, there is some call to action from them, right? So that is extremely crucial. Let's understand what a business model is. Instead of getting into the theory of it, let's just give a basic example and how it impacts your product decisions, right? So when you looked at, I don't know how many.
One question.
Shoot.
Okay, so Prajwal, when you were telling us about different types of costs, so it made me think, what about the sunk cost? So for example,
right,
if I am in midway of a project, but there is a sunk cost involved to it, what happens to that, and how do we account for the same?
Okay, one is accounting, right? Accounting is basically irrelevant in decision making right now. Yeah. So what we need from this perspective is let's go to your relevant costs and give you this example. So in the example that you told me, you've already incurred this expenditure and you're trying to build out a new product, correct? It doesn't matter. Don't consider the cost because you've already incurred it. So today, as of today, you need to consider the cost only the cost that will happen in the future, not that have already occurred, because your decision, say today, let's say the product is going to take another 2 months. You estimated it to be done today, right? So it's going to take another 2 months, and then your budget is, say, 60K more for whatever reason that you'll have to spend 60,000 rupees or 1 lakh rupees. You'll have to spend over the next 2 months. If you actually consider all the costs that you have incurred, say you have incurred 25 lakhs till now on building this product, you'll have to incur one more lakh. And let's assume that your customer is basically ready to pay only 25 lakhs itself. You thought, okay, no cost, no profit, but it's fine. Let's just do this project for the name, to have that reputation that we work with this bank or whatever it is, right? So let's say 25 lakh was your cost, 25 lakh, you've already spent it, and you still have to spend 1 more lakh to build this product and give it out. Would you let go of this entire project of revenue of 25 lakhs just because you have to incur another lakh today?
Right. So exactly, that's the decision I'm confused
right,
about.
Right.
That whether I should or I should not.
Exactly. So because it doesn't make sense to let go of a revenue of 25 lakh, all the costs that you have incurred in the past will always be irrelevant. I think that's the fundamental in understanding your relevant cost. I think here with this one small example, I'll make it quick. You guys can understand what I'm talking about. If you look at any historical costs or sunk costs, are basically costs that have already been incurred in the past. If they're incurred in the past, don't use them for their decision making. Although your budgeting, your accounts, everyone else will care about it, you as a product should not care about this. because it's already incurred. Variable costs are, like I told you, two costs, like two plans you have, and then they're not changing in the respective. You look at other qualitative and quantitative factors than just cost, right? So let's assume that you have built a product, you have expected to sell 50,000 units, okay? And variable cost, as you understand it, will be incurred only if you're selling the product or manufacturing it or whatever it is, right? 2.5 rupees you'll have to incur on the variable cost, and you're selling it at 5 rupees. Now, basically, you're selling it at 5 rupees, you're incurring a cost of 2.5 rupees. So you're making a profit of 2.5 rupees per product so that you can recover your fixed cost. Now, let's assume that you are getting an order for export and you have manufacturing capacity. Your fixed cost is remaining 75,000, irrespective of whether you manufacture 10,000 units, 50,000 units, 60,000 units. Your fixed cost is going to remain the same because you've already paid the factory rent, you already have the employees, etc. So now the question is, if your customer comes to you and tells you an export order is there, this is not going to impact your regular orders. If I want to increase the price of the product, I mean, you're selling it at 5, don't sell it to me at 5, sell it to me at 3.75. Would you still accept the order? Is the question. If you don't look at fixed cost the way I explain fixed cost, and if you look at all the costs as, say, 75,000 rupees divided by you're planning to sell 50,000, so 1.5 is your cost, right? Like if you look at fixed cost on a per unit basis, so you're incurring a variable cost of 2.5, and then you're incurring a fixed cost of 1.5. So 4 rupees is the total cost you're incurring on the product, and you're selling the product at 3.75 on the export order. You'll be like, no, I'm incurring a loss by selling it at 3.75. I'll reject the order. But that's not what you're supposed to do. You're incurring only 2.5 rupees additional amount. 75,000 rupees is your fixed cost. You have anyway incurred it, irrespective of whether I make 50,000 units or 60,000 units. And this 10,000 unit sale is not going to affect my demand of 50,000 units, and they won't ask me for a discount or anything. That's why your variable cost and fixed cost comes into picture, and you need to understand whether to ignore it or not. Coming back to your question here, let's assume that this fixed cost was your past sum cost. It can be your rent that you have paid. You've already paid the rent. Is that a relevant cost for now for when you're making the decision because you've already incurred it? No. So you ignore it, right? So that's where your understanding of fixed costs and relevant costs come in.
Great, right. Now I understand it. Perfect.
Okay, sure. Thank you. I think how are we doing on time? Okay, sure. I think we can. Like I wanted to cover a little bit more into opportunity costs and stuff like that. I'm just going to cover one small thing about opportunity cost, and then I'd like to give you guys examples of the Paytm dabbas and how revenue model there and we work and stuff like that, so that you bring in some concepts of pricing model as well. And guys, feel free to ask any question. Okay, as in when I see it, I'll just cover it. Okay, Prabhu, I see. Okay. Again, we are looking at this from a product manager's perspective, right? And as on today's perspective, this is not on the day one when you're making decisions for building out a product. When you're building out a product, sure. Thanks, Madan. I will share the spreadsheet with you. So the development cost, so at the beginning, right? So whenever you're making a budget for the entire thing, that's when you figure out whether it's profitable for you to go ahead or not. But then when you're already in the process of product development, when you've already incurred certain costs, and then you'll have to look at further things, that's when you need to, your thought process needs to change completely to try and understand what is a relevant cost and what is not a relevant cost. Let's take this small example. Okay, this is basically an opportunity cost. Opportunity cost is not actually a cost that you'll be incurring on a daily basis. Okay, salary of founder. I've been running the startup for 3 years. I've not drawn any salary. So will it hit my expense? No, it won't hit my expense account, nothing. But will I have to take that into consideration whether to decide whether I need to run the startup or not? Definitely yes. That's your opportunity cost. Opportunity cost is the cost that you are incurring or not incurring, like you're foregoing or the revenue that you're foregoing by taking one decision. It can be when you're deciding product development, right? So you have two products that you can develop in your manufacturing plant, only two products and nothing else. Like, I mean, either of the two products. Like if I develop product A, I won't be able to develop product B. If I develop product B, I won't be able to develop product A. So like that's where it becomes a little tricky to understand how much is the opportunity cost that you're letting go by manufacturing the other product when you by manufacturing this product. That's why your opportunity cost becomes a little more tricky, and those calculations might seem a little more tricky than the thing. But yeah, that's when your rest of the things work. Let's look at this example. Yeah, salary of the founder while deciding to continue a business or not. Your sales is 10,000, your variable costs are 4,000, your profit is 6,000, and your fixed cost is 5,000. So your profit is 1,000. Let's take different scenarios. Salary of the founder is 800 rupees, and the terms are not expected to change. Would you continue the business? Here, your salary is 800 rupees on the outside. You're making 1,000 rupees here in your business. You would obviously choose your business because you're making more profit here, right? Outside, if I go, I'm getting only a salary of 800 rupees. Now let's assume that salary of the founder is 1,200 rupees. And the terms are not expected to change, as in your fixed cost are same, variable costs are same, and stuff like that. Obviously, it doesn't make sense for you to run the business and then like pure financially. No one's talking about future growth. No one's talking about anything else. Nothing else is expected to change. Terms are not expected to change. You're expected to earn the same sort of sales, profit, etc. lifelong. You obviously take the salary outside. That is basically, you'll have to consider. You're not incurring this cost actually, the 1,200, but you have to consider it as an opportunity cost. Third case, salary of the founder is 3,000. Fixed cost is one time. This is where it becomes tricky. You're not incurring these fixed costs on a yearly basis. You've incurred it, you've bought a plant, and then everything that you need is done. Lifetime value of all the assets that you've invested in is in at least 20, 30 years. Over a period of 30 years, maybe the product will stop working. Would you consider 5,000 as a relevant cost in your decision making? That becomes extremely crucial. Maybe first year you consider it because some year you have to obviously consider fixed. After that, you don't have to consider it at all. Second year, I've already recovered my fixed cost in my first year by like earning a profit of 1,000 out of the 6,000 contribution that I had. Second year, all I'm doing is compare 6,000 and 3,000, because 6,000 is my contribution versus my salary of 3,000. That's when it comes, and then obviously you can't. Even if the salary is 5,000, because your contribution is 6,000, you still continue the business. It makes sense. So I hope this gives some clarity on opportunity costs and some costs, so that we can maybe cover a little bit your business model. And feel free, mentioned earlier. Let me just check the chat. Sure. Cool. Does anyone else have any questions? Please feel free. Having I mean, I don't want it to be me alone talking. Just checking one question. This is a great metaphor to understand cost dynamics. How do we deal with the assumptions in regard to sales that can be achieved via the new product? Okay. So Vikram, can you elaborate your answer a little bit more? I mean, question a little bit more. How do we deal with the assumptions? Like what assumptions in regards to sales that can be achieved by the new? So if you're talking about how I arrived at the 10 rupees or how I arrived at, sales projection, right? So sales projection is again very tricky, right? Whenever projection, it's extensive market survey is one of the ways. Larger organizations have budgets to do sales projection. But then startups, you'll never be able to project your sales. Sales to the teeth. I mean, larger companies also won't be able to. Like the example I gave you with Ford, that's when it becomes that's when Ford lost out on a lot of money. Not Ford, sorry, Fiat. They lost out on a lot of money. So sales projection is something that everyone's been trying to solve for ages, but always speak to your customer to try and understand. Simple thing that we do at Gordian is basically, because right now our target segment is jewelers. what we do is we try and estimate the number of orders that each jeweler that we talk to have, and calculate the number of, like, the total number of jewelers that are there in Bangalore within our serviceable area. Within that, we just go and identify how many jewelers are in what category, how many of them are wholesalers, how many of them are retailers, how many of them are maybe a different category, like, small independent store with non-multiple branches. And then we estimate demand based on, let's say we talk to 10 guys and projected 200 guys in the wholesale sector and stuff like that, for example. And then we project, come down one more layer and understand how many deliveries these guys need, how many deliveries will this segment need, how many deliveries will the last segment need. So obviously each of them will behave differently, and you'll have to treat them separately. And then based on all these different projections is when you can understand and to an extent estimate that this might be the demand. You can go extremely wrong if your sample set is wrong, or you have sampling bias or anything else. But again, sales projections are basically talk to your customer. That's a couple more questions. Okay, this is done. If anyone is free, and the same. So how many, like, okay, because it's not interactive, keep going back to that. Okay, like, so WeWork is basically a co-working space where they rent out their offices to businesses, very fancy buildings. Instead of you building out your own office, or instead of building your own, like, having your own AC, having your own help to come and like, clean every day, and security guard, etc., you can go work out of these co-working spaces. And basically earlier, the only way you could actually go and work out of WeWork was by taking their private offices. Their private offices are expensive, and then normally startups can't afford. So how do you solve for this problem? By just tweaking your business model. You have the same rental space, right? You have the same offices, and they have open areas where they had people who could they introduced a concept of all access pass, where anyone could go work out of a common area where, like, there are no designated seats. Anyone could go work out of any WeWork across the country. But even that became a little expensive for most startups to afford. So what they did was they introduced a concept of day passes. Now your day passes is basically only on the day that you actually feel like going. Many of us are working from home. Many of us get tired of working from home. So what we do is, when you go actually work on one particular day, you pay only for that particular day. Your coffee is free, everything's taken care of, and your team can call for like, on-site meetings, etc. And once they introduce day passes, their monetization of the entire floor is off the roof across the country. So they like, that's when you can think about how do you bring in different within your existing capabilities. And that's your hot desk and day passes, and that's where your business model tweaking can help. Like, say for Gordian, basically there are two models that we use. One is a delivery network where people pay on per delivery basis, but on the other hand, we have another business model. Business model is basically who are your customers, what is the product, how do you price it, how do you cater to them, and on what like, what is the product for them. For on the delivery network, the product or the service that we offer is deliveries, but on the other subscription model that we have, we actually offer the devices, like the physical boxes that we have built, now the IoT enabled devices that we've built on subscription with a dashboard and everything else, so that they can use it on their own fleet. So establishing this business model early on is extremely crucial, and choosing in most cases it becomes extremely difficult to choose either this or that. But if you like, choosing a business model, especially when you're smaller as a company, as a startup, it becomes extremely crucial for you to understand where you need to put in all your efforts. Because if your focus split, then your team is not able to deliver well on one front, like one business model, and same on the your business, how to think innovatively in terms of pricing your product and this thing, and your business is crucial. Let's take this Paytm Dabbas, right? So if you basis, like your Kirana stores and like even your tender coconut guys right now, these sound a payment, automatically they hear the payment done 10 rupees, payment done 20 rupees, payment done whatever it is, right? So what we learn that model, right? So how do you use that as a differentiation? There were thousands of companies who came in. Your phone pay was there, bar pay was there, and then multiple other companies were there sticking, and Google Pay was there. Everyone's fighting for the real estate outside the shop where they're like sticking their posters there. Some guy comes, removes it, pastes theirs, and then goes, and then no one was able to establish. What Paytm came up with was an innovative product that goes into product development. Again, you guys are the champs in that. You built a product, you built a dabba, a note, an alert, it's synced with your app, and there is sounds on whenever there's a payment. Products built. Now, if you go and tell a Kirana store whose monthly profits is 20,000 rupees, saying this cost me 4,000 rupees, so you pay me 4,000 rupees right now, and you will get an alert. They'll be like, no, I'll put in the extra work, I'll check this thing, I am not spending that money. All they did was they went and changed their pricing model. They told them, don't pay me 3,000 rupees or 4,000 rupees or how much ever this product costs. Pay me 50 rupees per month. That's it. Or 100 rupees per month. How much ever possible, or depending on the shopkeeper and the sales guys, they cut a deal with them. 50 or 100 rupees for a shop is not a big deal, because there are a lot of scams where people show, like, use fake apps and everything else, and that's how they revolutionized the way, the payment app that is there in a shop that they go to. And that's how things, that's how they capture the market. Any Bangalore shop you go to, every shop in every Kirana store in Bangalore has a Paytm dabba, and now it's synonymous to you talking and telling payment is done. And you just wait for the sound to come and then you just walk, right? So understanding how do you price your products and what is your business model becomes extremely good and interesting for you to decide on your product development roadmap. And I think that's it from my side. I've covered most of the things I wanted to cover. And if you have anything, please feel free. I'll just see the questions. I don't think there is any.
Prajwal, it was fantastic session. I think what we'll do is we'll take the last 5 minutes to summarize a bit and also ask some of our product manager volunteers who have joined us, Daisy and Pooja, about what are their takeaways.
Sure. We can start with their take, maybe talk, because we've been talking for quite some time now.
Sure, no worries. No, in fact, from my end, I learned a lot in terms of the fixed variable costs, the business models. It's good that you brought up, about fiat. In fact, fiat today, a lot of youngsters call it fiat currency. I'm not sure if they remember the brand.
Knows about the brand. Yeah, right.
And also, it's good that you brought up the willingness to pay. How much people are willing to pay. Very often, many of our techies, we forget to understand and talk to the customer.
Right.
So it's great that you brought these points up. What I'll do is I will also ask our students. So Daisy, would you like to share your takeaways in a brief, what you learned from the session? And then Pooja?
Sure. So to be honest, it was a great experience, especially learning about everything. And the best part was Prajwal touched everything, like the costing part, the willingness to pay part, like all the basics. We started with the break-even point, which is as easy as the profit loss thing, and then the slope slowly inclined, and we ended up learning about the different business models. And to be honest, the best part was how finance is actually getting integrated with the prodman field. That is one thing which I really liked. And to be honest, since you ended up talking about the Paytm dabbas, I happened to work in Paytm before joining IIM Calcutta, and my project, I was one of the software developers working there. So that particular project is really close to my heart. So
yeah, that's one example I talk about. I'm super impressed with the product. Such a basic innovation, but such a huge game changer for Paytm.
Right. So I think it was a completely great experience for me attending this. Thank you so much, Prajwal. Thank you so much, Vinay, for this. And I had a wonderful, knowledgeable 1 hour. Thank you.
How about you, Pooja? Are you able to unmute yourself, Pooja? Would you like to share your learnings from the session? Yeah, I think we're not able to hear you, but yeah, I think there is some issue with the mic. But I think one more thing, Prajwal, that speakers had was the resources that you have. You have a lot of resources. So we have our community channel where we have thousands of aspiring and expert product managers. So what we can do is we can share your resources in the event channel over there.
Would be more than glad to.
Everyone can
access them. You want me to share it, or will you? Can I share them with you? I made these.
Yes, you can share it with us, and we will reshare that. And you could also join us there sometimes. A quick AMA question answers. We'll put them across.
Be more than glad to. Yeah, more than that.
Great, wonderful. Any final thoughts? We have a couple more minutes. Some of them also want to know, how do they get started? How do young product managers get started? I see Sonali also is delighted with this session. So how do young product managers get started while they're...
Hello.
Yes, Pooja, go ahead.
Finally, here's Pooja, and thank you so much, Amit sir. He gave me opportunity to interact with you all and attend the national level first event related to product based management, and I am really thrilled and to it was really informative sessions, and I learned so many things. Like, before proceeding your business model, you should take a look on the how customers, whom you are going to target, and what is your product, as well as how you will part the finance and all the stuff. If your finance is not much well going, like you don't have that much, so how will you able to manipulate or make your product so much attractive so that they can customer can attract it, as well as things I just learned decision making and finance related decision making. That is very crucial thing. I mean, in nowadays, if we are going to do any startup or something, so the main important fact, which is whom we are going to approach for financial support. So that was a really good, and I learned so many things. Thank you, Prajwal, for giving us two opportunity to I'm honored, and I would like to attend so many sessions with you. Thank you so much.
Thank you so much. Taking the time at such short notice. I see that they like the presentation. We are getting a lot of feedback. One of them want to know a framework to factor in how fast the competitors can copy the product innovation in the absence of patenting strategy. Would you like to take that?
Yeah, I mean, so patenting was very close to my heart, because before I started, I started immediately after I finished my CA. So I was in this, I was completely new to the world of startups, had no clue about how to even do this. And I was extremely paranoid about the idea being stolen. And that's when, for the first 8 months, I didn't talk to anyone about it. Please don't make that mistake. Please go and talk to people. Please go and talk to your customers right from day one. Although there are competitors right now who have copied the product, but then it took them 2 to 3 years for them to do this. No one's gonna look at your idea and be like, okay, I'll leave everything that I'm doing and then start building this. In extremely competitive markets like your Paytm Dabba thing, definitely, obviously, there can be competition, because everyone's eyeing for that space. Everyone's investing, the number of the amount of money that just goes into your sales guys, operations guys, to go to each and every store and put the product is huge. So there it becomes extremely crucial for you to get your patents in order before you release the product early on, because there are people literally eyeing for the market. But having said that, I don't think for Paytm Dabba, the innovation was it was not about the innovation, it was about distribution. They already had the distribution. They already had guys on field. No one's going to pay rent to another product by PhonePe, which is solving for the same problem. They're like, I already have Paytm. So your first to market there makes a huge differentiation, and your distribution becomes a huge difference there, more than your patent. No one wants to be stuck fighting for 5 years in the code for a dabba which can speak, when 5 years later, maybe UPI payments through QR code might not even be relevant. Right now itself, WhatsApp has integrated payments. So you can always look at patenting differently.
I'll just ask Prashant, how are we on time? Can we take one more question, Prashant? Yeah. So we have a quick question on so how do they assess financial risk before working on their product?
Okay, this is an entire topic by itself. Whenever you're looking at financial risk, obviously your fixed cost becomes your your most important risk that you'll be taking. Whatever you're incurring upfront, whatever you're incurring for sure, irrespective of whether you sell the product or anything else that becomes. So try and look for ways to minimize your financial risk. When we were building out the product, the physical dabba, we had to either go through injection molding because we couldn't go through metal because the weight of the product and the delivery guys can't carry them. Now we had to go through injection molding, but injection molding is a process where at least the tool cost would be 20 lakhs upfront, and I'm not even sure of the size of the box that I need, right? Which would work because we're introducing a totally new product to the market. So it doesn't. So then we started going to the market just with an idea to figure out how do you build low volume boxes, low volume manufacturing processes where the cost is not as much as high as possible, as high as a tool for your injection molding. And that's when we were able to identify processes which would minimize the financial risk, and that's how we got started. And I think that that's a decision you need to take, where you try and keep your cash flows at the minimum, especially if you're running a startup. Again, depends on case to case, and then your financial risk can change.
Right. We have one more question. We can take another minute. We have Shesha talking about, in a SaaS model, how do you decide the pricing when churn possibly could be very high?
Okay, let me just read the entire question. How do you decide the pricing when churn would be very high? How do you protect SaaS pricing to ensure profitability to cover your... Okay, so here, basically, that's where people bring in 3 months upfront pricing, try and get people to pay as much as possible upfront, or you have discounts, say on Webflow. Whenever you're making a payment, they're like, pay monthly so much, pay yearly so much. I'll give you 10% discount, 20% discount, where you offer different pricing to your customers, where you prompt them to commit for a longer period of time. Larger organizations do this through agreements where they're like, say one of the tools that we use, basically we got into a lock-in period with them for a year, and we had to commit for incurring the expenditure for a year for them to go through the effort, and we had to go through the effort. And again, that goes into your decision-making process as well. But try and get your customers either through financial discounts or product discounts or pricing discounts or anything else, or extra features if you subscribe for a longer period of time. And that's the only way you can handle your you can minimize your risks.
Yeah, great. So I think I would again like to thank the audience, Prajwal, for your time, compelling shares. In fact, all these questions, we're going to put it up on our Slack channel, so we can also let the other community folks share their inputs. Sure. And we look forward to more of you joining us for our upcoming sessions. This concludes the February set of webinars and learning and development. In March, we have something really exciting for many of you. So do join us on the Slack channel, and we will keep you posted on updates. Thank you again, Prajwal, and thank you, everyone.
Okay, thanks.